Folks, welcome to Best Stock Charts for February the 24th. The month is almost over, and what a month of volatility it has been. Let's begin with how our week was last week. It was a mixed week. Unlike some of my competitors who will only come out and tell you about their winners, I like to discuss our losers as well. Why? It's because that's how we learn. So I want to discuss SOXS, the Direxion Semiconductor Bear ETF. We added to this position, I believe it was on Wednesday, and on Friday, I said, you know what, let's get out. And I received an email from a member who said, you know, why are you stopping out now when you said your stop point was going to be on a close below $12.05? The reason is this, is that the market sends you signals. I say this all the time because many people believe the market is corrupt, the market is rigged, and for the most part, yeah, sure it is. But that doesn't mean you can't make money if you know the charts and you know the probabilities. Now, simply taking a look at the chart of the SOXS, the fact that we broke down below a support level after breaking out earlier in the week, that was a sufficient enough of a reason for me to stop out of the position. But I did commit to members when I said on a close below 1205, we would stop out of the trade. Why did I stop out of the SOX trade prior to hitting that support level and closing down below it? It had nothing to do with this chart. It had nothing to do with the semiconductor sector. It had everything to do with this chart. The 10-year yield weekly chart. We'll discuss the chart of the 10-year yield in greater detail on the week ahead commentary with members, which is coming out tomorrow. But this is the chart. Because remember why the markets were coming under pressure and why the shares of SOXS were rallying. It's because yields were rising. So if you have yields which are pulling back, well, then it stands that in all probability, you're going to see a pullback in the bear ETFs as well and a rally in the market. So how do I validate my thesis? The S&P 500 daily chart. It broke out of a triangle formation on Friday. It was my bet that we wouldn't rally up and through 2574, which we haven't yet. However, the fact that we rallied up and through this resistance level, and it could be a short covering Friday thing where shorts covered their short positions and they went away for the weekend. And that's quite possible to skew off an Aspen. But what I wanted to do was minimize my risk. Did I take all my shorts off the table? No, I did not. But I did lighten up on our short positions because it was the rational thing to do. And why might I believe the S&P 500 saw a short squeeze on Friday? Look no further than volume. So back to the chart of the SOXS, knowing that yields saw some pressure late last week and the weekly chart showed some topping action and that we may see a rally in the bond market. And again, members, we'll talk greater detail about our strategy as we proceed into the coming week. In fact, that strategy began on Friday by lightening up on shorts, because I do believe that in all probability, given all of the catalysts that we have coming out next week, and it's not necessarily economic, it has to do with Powell being in front of Congress, the new Fed chairman. All of these are catalysts to move the markets in one direction or the other, and that's going to be the gist of our conversation with members as we proceed into the new trading week. If you're not currently a member, join up. Go into the week informed. Now, what would get me long once again of the SOXS? Well, if I saw yields rallying and I saw any pullback on the SOXS get met with buyers bidding it back up and flashing a bullish key reversal, I'll be back in. I'll be back, right? The Terminator. So what is a bullish key reversal for those folks who don't understand charting or what the terminology is that I'm using? This is a bullish key reversal. December the 4th, 2017, where we traded down on the day only to close higher on the day, and we engulfed the prior day's move. That is a bullish key reversal. Now, you may be saying, you know, Bob, if it's such a bullish reversal bar, then why did we break down to new lower lows? The reason is one day does not make a trend, right? Two is that when you take a look at a monthly chart or a weekly chart, but we'll use a monthly chart, you could see that the trend is clearly down, right? So lower highs and lower lows. One day is not going to change that when you have a chart looking like this. So you wouldn't want to bet that one day's bullish key reversal is going to break this downtrend by no stretch of the imagination. You need a breakout on a monthly basis above the upper band of resistance, which is at current at 1842. You want to see it close above that level. We're nowhere near that yet. So going back to why we stopped out of this trade so soon is because we know from the higher level view, the monthly chart, that if we stuck around long here, you know what, we're probably chopping off our nose to spite our face, because the probability of the downtrend resuming is very, very high because it hasn't been broken yet. So the question I had to ask myself, are you fighting a downtrend? And the answer is yes. Despite the fact, very short term, it looked promising to the upside. But we've been here before, right? So we booked a loss. We may, in fact, be back in yet again. But in short, I feared a rally in the market moving into next week, and the probability of us taking out $12.05 was very high. So just because you have an exit strategy, it doesn't mean that you can't be proactive and say, you know what, the charts are telling me here that in all probability, we're going to break down to new lower lows. Let's keep that loss small and not wait for the breakdown. And as I always like to say, first out, best out. We move to the sidelines, build cash, look for other opportunities. Let's move on to Shopify. Now, this is one where we booked profits on last week. And I don't want to spend too much time on this because I like it more as a longer-term trade. I think that there's more to gain from discussing our losses, right, our strategy, rather than saying, okay, I bought the anticipated breakout here and I sold the following day. Why? It's because we were seeing some weakness move into the markets and the fact that we were coming off of hitting the third standard deviation Bollinger Band, which we're not supposed to be. My discipline is, and when we're up there, I book profits. No matter how short term, I book those profits. I make them real. And in this case here, it paid off. Because now what I need to do is I need to update this chart because we pulled back and we actually flashed a breakout point failure, or as some of you know it as being called a bull trap. That's when you break out and then break back down below your breakout point. But the markets send you signals, right? This is the second time I'm using that phrase in this video. Why? It's because it's the equalizer. It's what levels the playing field between you and that Wall Street banker who's got every Bloomberg machine possible and his own proprietary algorithm system trying to beat you at his game. And it's not easy to do so. But when you're using the charts and you identify the fact that, well, you know what, while we broke down and we reversed on Friday to recapture that support level, that's a tell. That's telling me that while these shares should have gone down lower and they didn't, and we rallied back to recapture support, there's demand out there. And the next area, the next metric I'm going to look for on a price move like this is volume. Now, volume was light. So this plays into how I plan on trading SOHP this coming week. Members will talk more about our strategy for SOHP on the week ahead commentary coming out tomorrow. Again, if you're not currently a member, sign up, join the club. The next chart up, we're going to go over weekly charts here. I have a lot to go over. Members will do deep dives on those trades that I really am hot for, and we'll be looking to put on early next week. But right now on best stock charts, we're going to do a really high level view. Buckle, weekly chart. I've been talking about Buckle for the past couple of weeks now, and we flashed last week a bullish key reversal off of a breakout point, but we haven't been able to follow through on the breakout. So while I think Buckle is moving higher, You do have some overhead resistance here. So I want to show some discipline, not buy prematurely. I would rather buy on strength. And we'll discuss that breakout on the week ahead commentary. Another comment that's worth sharing here is that volume was very light last week, way below the moving average and way below the prior week's up volume. That is a concern. So we're going to want to do a deep dive into the daily chart and perhaps even into the 2-hour chart to see whether or not we want to be involved here. Now, the stochastics, they're moving up higher and breaking out. RSI, you really wouldn't expect it to break out yet because we haven't broken out above the prior week's high. So we're moving in the right direction. We're stalled out here a little bit on RSI. So members, more to come on Buckle. The next chart up, HACC. This puts you long of the cybersecurity sector. You have some good plays in here. You have Palo Alto Networks, you have CyberArk, you have FireEye, all are good companies. But if you want to avoid the headline risk of an individual name, HACC is your play. And you can see that on a weekly basis, we broke out the week of February the 12th. Now, we've been there before, right? We broke out the week of January the 22nd, but that breakout failed. We have, however, rallied back. This is a sign of relative strength versus the S&P 500. What do I mean by that? Well, the S&P 500 did a little bit of a bounce last week, but it still hasn't rallied back to new highs year over year, whereas HACC has now taken out the year's high. So relative to the S&P 500, HACC is showing relative strength. This is leadership. So we are going to be looking to build a position on HACC. Members, more to come on the week ahead commentary. Under Armour, this is another one. I've been discussing it. I like the setup here. Higher lows in RSI, higher lows on stochastics, higher lows on price. We have broken out on price. We aren't seeing a continuation breakout yet. What I think may happen here, and it's a good thing, is we may pull back further and retest the breakout point. Now, there's no law that says that that's going to happen. We may, in fact, proceed higher from these levels and never look back. So there's a strategy that we'll put into play, and we'll discuss that on the week ahead commentary about how we want to build a position in Under Armour for the longer term. Because I think that we are done with the downtrend. I could be wrong, so I'll have to talk about an exit strategy, but I think for the most part, we are done with the downtrend, and the path of least resistance has gone from being bearish to now being bullish. There are still some obstacles to overcome. I wouldn't overweight the shares just yet, but members, more to come on Under Armour. Weekly chart looking good. The next chart up, more of a speculative trade, Sea Change International. I love weekly charts like this, orderly. Pullbacks, volume dropping off to the downside. Good stuff. All right, so what happened here? What's the higher level view picture here? Sea Change was in a long-term downtrend. It went into a about a year-long base in which it broke out in December. It broke out above 2.99, which was the pivot point. What does that mean? Well, we put in a higher low. The center of that W formation was at 2.99. We broke out in December. A strong rally up to $4.03 in late December, probably on a short squeeze and on the fact that oil was beginning to rally. We got our pullback along with oil and the rest of the energy complex. We are now consolidating, a 3-week consolidation at support. Now we're looking for a breakout. So members, more to come here on this speculative trade on Sea Change. The next chart up, not so much of a speculative trade, but more of a longer term trade that we'd like to put on, and that's in the energy sector, which had been in fuego, right? But that trade has fallen apart. I've just updated this chart to add this line here so your eyes aren't deceiving you. So while I'm bullish on the energy sector, let's face it, let's be completely honest with each other here. There has been a ton of technical damage done here. But the fact remains in that, let's update this once again. Okay, so what I added here was this lower band of support. So the fact remains that while we were in a downtrend back here, that downtrend has been broken. All right, we broke it when we rallied up to 44.11. We pulled back, we put in a higher low, we rallied again. We took out the prior high ever so slightly, but we did take it out. So we're putting in higher lows and higher highs. So to me, the new bull run is still intact. Now, when you add into the fact that I believe that the dollar, the US dollar, is probably going to weaken, therefore strengthen the price of commodities, which were strong last week. Simply take a look at oil. Big moves higher last week, not as technically damaged as the energy sector. Back to that chart. We know that if oil breaks out to a new high, ERX in all probability is going to continue higher as well. So from a risk reward perspective, where we bounced last week was where we had support and resistance prior. It was support back here on this bullish key reversal. It was support back here multiple times. It was resistance back here the week of June the 5th. And again, back here in July, 2 weeks in a row. Support yet again back here in September. So a lot of history at the support level. So our risk versus reward is clear, defined, and reasonable to accept. Now, when the shares were ripping up and through the second and third standard deviation Bollinger Bands, I was warning members, this is not going to end well. Don't go chasing these shares. And sure enough, we rolled over. So ERX is looking interesting. I don't think that these shares are necessarily going to go skyrocketing higher immediately, but I think that we could begin to nibble on this pullback. So members, more to come here. And this will be a longer term trade, not a short term. Target, weekly chart. I have a couple of retailers, actually 3 retailers I'm going to go over. I would only trade one. Now, Target on this weekly chart is inside of a triangle formation. No breakout yet. I would be looking for a breakout to new all-time highs, which is sexy stuff. Why is that sexy? The reason is that when you take a look, let's go to a monthly chart. When you take a look at a chart like this and your experience as a technician and buying momentum, you appreciate the fact that we are at all-time highs, because what is non-existent when you're at all-time highs? Exactly what existed back here when we bottomed out, we proceeded higher. You had overhead supply, right? You had buyers back here every step of the way, selling into strength, selling into strength. You don't get that when you break out to new all-time highs. You do get profit taking, but you don't get the emotion of overhead supply, people wanting to get made whole and selling the second that they're made whole on that trade they've been looking at as a red entry on their trading platform for months, if not years. The minute it goes green, they're out with no other logic other than the relief of being made whole after a long waiting period, and it's completely natural. So Target looking good, but we want to see a breakout. Members, more to come on the week ahead commentary. Costco. We've spoken about Costco several times in the past, and it's been volatile, very, very volatile. I talked about it here while it was consolidating within this flag formation. It broke out, the market fell apart, and so did Costco. It showed strength when it recovered on February the 12th. It recaptured the breakout point. Last week, we retested the breakout point, and we closed above it. So while this was a down week last week, I view it as being a bullish week. And some of you may be shaking your head saying, wait a minute, guy. The shares closed down on the week by nearly a percentage point, yet you're saying that it was a bullish week? Yes, absolutely. Why? It's because we closed well off the lows of the week, and we closed above a support level. That is a validation that this support level is holding. So that's my case for making a down week a bullish week. Volume was extremely light, right? So this down volume was not on institutional selling. This was on traders waiting for a retest of mom and pop selling 100 shares, pulling it back down and waiting to see whether or not you're going to have Fidelity, Goldman Sachs come in and pound the shares on Friday and close it down below the support level. That didn't happen, right? And it's probably not going to happen. It's all about probabilities. It doesn't mean it can't happen, right? I don't provide a guarantee here. The probability is that we are going to break out to new higher highs on Costco. Would I go buying the shares on Monday morning based upon my opinion? No. We're going to buy on fact. And we'll discuss what I believe to be a factual and a safe risk-reward entry point on the week ahead commentary. Members, stick around for tomorrow's commentary. The next chart up is Lululemon. You know what? Let's first go to a monthly chart. Now, the month isn't over yet, so we really can't trade off of this, but we have broken out on a monthly basis for the month of February. So if Friday was the last trading day of the month, we would have had a bullish breakout on the month. Still a couple of trading days left to go. Anything could happen, right? But we did break out earlier in December on RSI. So we have an indicator leading price performance. We pulled back, we're retesting the breakout point. We are now moving higher, validating February's breakout weekly chart. So we know from our higher level view that Lululemon is breaking out nicely, but we are not at the highs of the month. We did pull back. We were in a bull flag formation. We broke out. We hit a resistance level at 82.64. We're very close to a breakout point. We will be discussing an entry point for Lululemon on the week ahead commentary. Volume last week was a concern, right? So if and when we do break out here, we will be looking at the volume bar to ensure that this breakout is on volume, because what you want is to have your institutional money flow act as a wind at your back when you're buying a share of stock that is breaking out to new all-time highs. So members, more to come here on Lululemon. But I like the shares. I think that these retailers, Target, Costco, Lululemon, are in all probability breaking out. Activision Blizzard, ATVI. I guess it's another retail stock. You want to call it technology, all right. But it's another retail stock, right? But it too is showing a sign of strength. We're very close to an all-time high at 74.94. Volume last week was very light. So this is the theme, and we'll talk about this on the weekend commentary more. Volume was very light last week to the upside. So for those who believe that the sell-off in this market is over, don't get lured into a false sense of security. When you see institutional money flow rotating back into this market at new all-time highs, then you could breathe a sigh of relief. Not yet. So ATVI looking good. Bullish key reversal on the week. A new weekly high week over week. No breakout yet on RSI. Stokes just may be hooking back up. So it's one to watch. MACD is still in a downtrend. It's one to watch. Not my favorite per se, but that could change on Monday morning. The next chart up, EGY, another energy stock, but this is more of a spec play. And I first started talking about EGY back here while it was in this tight consolidation. Very similar, in fact, to the pullback that we've seen on Sea Change International, right? Very tight, orderly pullback on light volume. The same deal here. Not as orderly, to be honest with you, on EGY. But we have broken out of that downtrend. Has the overall, the higher level view downtrend changed yet? No, we're not in a new bull run yet, but we are at the precipice of one. So on spec, I think that these shares are very close to a buy, and this is one where I would be a buyer on strength as we begin to take out prior resistance levels, especially at 1.43. I would be an aggressive buyer of the shares. Members, more to come on EGY. And that's it for this week, folks. If you're watching this on YouTube, please subscribe to my channel. Get my daily early morning pre-market updates, as well as member stock chart request, which is where I review the symbols our members submit for me to review. Leave a comment on YouTube. Leave a comment on StockTwits or Twitter. Follow me there. Members, I will talk to you tomorrow on the week ahead commentary. That's where we'll review the health of the overall markets on Market Pulse Check. We'll review our positions, and we'll talk strategy with regard to how we plan on trading this market into next week. and what the economic catalyst may be to drive the markets higher or lower in the next week or so. Everybody have a great remainder of your weekend, and I will talk to you soon. Be well.